Hi. In one of my previous sessions, I talked to you about the generalities of U.S. state and local tax Nexus. I wanted to delve a little deeper into how Nexus is affecting income taxation in the United States. As I mentioned previously, most people think that they're covered by the treaty and so therefore they have no U.S. tax. Well, that's not really true. When you think about state and local tax, you need to look at the U.S. as if it's 50 countries with one common army. In other words, none of the states sign on to the treaty, and so therefore they're not bound by the treaty. So they can impose their own income tax. What's even more interesting is that quite often you will have various counties and cities within the U.S. that also impose an income tax. So making sure that you don't have Nexus, or whether you do have Nexus, is very important, as there are over 8,000 jurisdictions that can seek to attach a tax to you. One of the important concepts when dealing with state and local income taxes is a federal law called Public Law 86-272. This law was passed by Congress in the early 50s as an attempt to help a blossoming door-to-door sales industry and a blossoming interstate commerce. Basically, what Public Law 86-272 says is that if a company's only contact with a state, or its only activity in a state, is the mere solicitation of orders for the sale of tangible personal property, where those orders are sent outside of the state for acceptance or rejection, filled from a stock of goods held at a point outside of the state, and delivered via a common carrier, then that state cannot impose an income tax on that company. The law goes even further in restricting the imposition of those localities that I mentioned a little earlier. So if all you're doing is soliciting orders, you may not have Nexus for state and local income tax purposes. Now, let's peel back some of the layers of Public Law 86-272 just to see what it does and doesn't protect. First of all, the law protects for the mere solicitation. So if you conclude contracts, you've gone beyond the mere solicitation of an order and you're no longer protected. It also covers just the sale of tangible personal property or goods, so services are not protected, and software as a service often will exceed the protections of Public Law 86-272. The next stipulation is that the order has to be sent outside of the state for acceptance or rejection. Many states are going to look at the procedures that happen outside of the state, and if it's merely just a rubber stamp, they're going to say that the order was accepted at the time it was taken, and therefore they're going to withdraw the protections of 86-272. The order has to be filled from a stock of goods held at a point outside of the state. California has held that the stock of goods has to still be within the United States because they believe that if the stock of goods is held in a foreign country, this is now international commerce rather than interstate commerce and is no longer protected. And the goods have to be shipped by common carrier. The states have relaxed a little on this, as some of the court cases that have come out after Public Law 86-272 have shown that merely dropping off goods, whether it be in a company-owned vehicle or common carrier, really don't create any additional contact. So as you can see, there's a lot of complexity that arises when dealing with whether you have Nexus for state income tax purposes or local income tax purposes. We recommend that you sit down with your tax advisor and go through your personal circumstances to understand whether or not you have an income tax obligation in the various states. If you have questions about U.S. state income tax Nexus and would like to speak to somebody, please feel free to give one of our cross-border specialists at Aylett Grant Tax a call. We're happy to help and we're here to serve. Thank you.